A weak start to September raises questions about the rest of the month as bond woes spill over into stocks. Wall Street traders returned to their offices on Tuesday and were greeted with a sell-off in global bonds. Worries around rising debt piles has eroded sentiment towards some of the world's safest assets, and the weakness spread to the equity markets. September is traditionally the worst month for markets. Should investors brace for a bumpy ride? Russ Mould is investment director at AJ Bell. Is this just another September sell-off or just something else at play?
Well, I think it depends where you look. If you're looking at Japan, France, the United Kingdom, for example, to a lesser degree the US, there are gathering worries about a longer term story, which is galloping debt accumulation and whether governments really can indeed successfully fund those debts without simply having to perhaps resort to printing more money. If you look at the shorter end of the curve, 2 to 5 year, for example, then you're not actually seeing that degree of pressure at all. Their fixed income investors are looking forward to interest rate cuts, which they may construe as good news.
While longer yields climbed after US manufacturing activity contracted for a sixth month, will bonds continue to be pressured lower if data keeps disappointing, especially with NFP due up this Friday?
Yeah, again, if the jobs data is weak, and it'll be really interesting to see how that falls out after the trouble that the last set of disappointing numbers caused, again, you would possibly expect the short end of the curve, the shorter dated bonds to respond to the prospect of interest rate cuts. But again, longer dated yields, they're responding to worries over inflation, central bank independence. So you may actually get different responses in different parts of the curve and this ongoing potential bear steepener in the curve that we're seeing right now.
Well, let's talk about interest rates, and markets are almost certain that the Fed will cut in September. Is there a risk of another sell the cut fact for US bonds?
It's always a possibility. Markets do tend to travel before they arrive, to use one of the oldest cliches of all, and 2, if not 3 rate cuts are now priced in pretty quick succession from the US. Again, the reasons for that cut will be as perhaps past as much as the actual degree. Is it because the president's leaning on them? Is it because the jobs market's weakening? And are they taking an undue chance with inflation? So there'll be lots of different considerations there.
Another consideration, legal questions around Trump's tariffs are putting hundreds of billions of dollars in potential government revenue in jeopardy. Are concerns about the US deficit warranted?
I think ultimately, if you look at the rate in which the United States has been accumulating debt for most of the last 50 or 60 years since Nixon smashed up Bretton Woods in 1971, the pace of debt accumulation has accelerated. And it can't really go on forever. So at some stage, you would assume there'll be a reckoning, either in the form of spending cuts, tax increases, politically very difficult to see, or something a little bit more creative, dare one say, letting the economy run hot, taking a risk with inflation, or even more unorthodox monetary policy like quantitative easing. And maybe that's what gold bugs, for example, are looking towards. And that's why gold is rocketing right now.
US stocks have gained for 4 straight months. Are persistently rising yields a threat to the bull market going forward?
It doesn't seem to be at the moment, but you would think that the higher 10 and 30-year yields go, the more of a competitor they become to equity returns, for example. And there is that risk eventually the transmission mechanism into the real economy starts to have an effect. But that takes 18 to 24 months. So the reckoning may be away a little while yet. And at the moment, US long-dated yields are not rising as much as those, as we've mentioned earlier, in the UK, France and Japan, for example.
So finally, Russ, and you just touched on it, this is a global sell-off. Where in the world is your biggest worry right now?
Out of the UK, US, Japan and France, where we're probably seeing the most action in the long run right now, probably France, because it's got the least scope for independent action, as it were, on a monetary policy basis, because it's tied into the European Union.
That was Russ Mould from AJ Bell. Don't forget, you can watch more videos on Reuters.com.